Welcome to the Deep Dive. We're Talk Tickers, and we cut through the jargon of earnings calls so you're always ahead of the curve.
That's right.
Today we're diving into Sportsman's Warehouse Holdings, ticker SPWH. They just released their Q2 fiscal year 2025 numbers.
And there's quite a bit to unpack there.
Absolutely. Our mission here is to really dissect these results, pull out what matters, and figure out, well, what the story is. The market seemed a bit hesitant, so let's see if that holds up.
Let's get into it.
Okay, so headlines first. Sportsman's Warehouse.
It felt like a mixed quarter, wouldn't you say? But maybe cautiously constructive.
That's a good way to put it. Yeah. Mixed, but with some positive signs.
Revenue came in at $293.9 million. That's up 1.8% year over year.
And importantly, a slight beat against consensus, about 0.8%.
Right, small beat. And they managed their second straight quarter of positive comparable store sales, up 2.1%.
That's definitely a key metric investors watch. Seeing that positive again is, well, it's encouraging on the surface. And profitability. Gross margin improved 80 basis points year over year, hitting 32.0%.
Which is good progress on margin. Adjusted EBITDA was $8.3 million.
Okay. Earnings per share. GAAP was negative $0.18. Adjusted was negative $0.12.
And that adjusted figure was basically right in line with what analysts were expecting.
Exactly. But here's where, the questions start. Inventory levels. Pretty high at $443.5 million.
Yeah, that definitely jumped out.
And net debt also up. $195.1 million. Management calls this strategic.
But the market clearly noticed and probably got a little nervous. It's drawing scrutiny, no doubt.
So is this just a temporary blip, a planned move, like they say? Or is there, more risk here than meets the eye?
That's really the core tension, isn't it? You've got this positive comp sales number, 2.1%. That's not nothing. It shows some strategies are starting to work.
Right.
But the deeper question is how? Is it sustainable growth? Are they really pulling in new customers or just, doing better in certain areas? Understanding that why is key.
Okay, so let's dig into those areas. Category performance. Firearms and hunting.
Up 4% in sales. And here's the interesting part. Their firearms unit sales were up over 4%. Even while the overall market, proxied by those adjusted NICS background checks, was down almost 5%.
So clear market share gains there. That's significant.
It really is. In a shrinking pie, they're taking a bigger slice. The question for you, the investor, is, how durable is that? Is it better inventory, pricing, or just temporary? We did see some signs of trade down behavior. Average price per firearm dipped about 4%.
Okay. Less spending per gun.
Right. But attachment rates, people buying accessories, ammo, scopes with the firearm, those stayed strong. So the overall average order value, the AOV, held up pretty well.
That helps offset the lower unit price then. Smart.
It does. So firearms gaining share, but with some pricing nuances.
Got it. What else stood out? You mentioned fishing earlier.
Yeah, fishing was, frankly, a standout. Sales surged nearly 11% year over year.
Wow, 11%.
And if you look at it on a 2-year stack, it's up an impressive 20%. That really suggests they're capturing growing interest in fishing, maybe new participants, and their inventory strategy there is hitting the mark.
Okay, so fishing's a bright spot. What about camping?
Camping. That was the flip side. A disappointment, actually. Down 10%.
Ouch. So what are they doing about that?
They're trying a few things. Implementing an everyday low price, EDLP, strategy on core consumables, kind of like they did successfully with ammunition.
Okay, trying to replicate that playbook.
Exactly. And bringing in new assortments, like partnering with popular brands. Yeti was mentioned. They say that's showing some early positive signs.
That adaptability is important, but yeah, turning around a 10% drop in a competitive category like camping, it takes time, right?
Absolutely. Execution is everything there. And this ties into their broader strategy, this localization plus digital playbook they talk about.
Right. Tailoring things locally.
Yeah, and it seems to be working in some places. They highlighted Alaska, for instance, saw high single-digit sales growth. It shows that getting the right products for the local market, plus targeted digital ads, can work.
Makes sense. But can they scale that hyper-local focus everywhere effectively? That's the challenge.
It is definitely something to watch.
And the digital side overall.
Yeah.
You mentioned omnichannel.
Yeah, e-commerce grew 3% year over year. But here's the really interesting part, I think.
Okay.
Over 70% of those online orders were picked up in the store. BOPUS, buy online, pick up in store.
70%. So online isn't cannibalizing stores, it's actually feeding them traffic.
Precisely. It's a powerful synergy. Using digital to drive valuable trips to their physical locations, it makes those brick-and-mortar assets work harder.
Smart. Okay, so let's circle back to that elephant in the room, the inventory and the debt.
Right. Management's explanation was very clear. This was a deliberate strategic pull forward.
Meaning they bought inventory earlier than usual.
Exactly. To make sure stores were fully stocked, season ready for the big late summer and fall hunting seasons. They explicitly said they wanted to avoid being late to market, which apparently hurt them in past years.
So they're framing it as a proactive fix to a past problem, not a sign of slowing sales causing inventory buildup.
That's the narrative. It's a calculated bet that they can sell through it effectively.
But for investors, the question remains, can they? They plan the buildup, but can they execute the sell down without, heavy discounts?
That's the million-dollar question. Management was emphatic, though. They said Q2 was the peak for inventory this year.
Inventory, okay.
They expect to sell it down starting in Q3 and are confident they'll end the fiscal year with inventory below last year's levels.
That'll be key.
Yeah, the plan involves simplifying assortments, driving working capital efficiency, and the new CFO, Jennifer Fall-Jung, she doubled down on this. She said Q2 likely marked the peak for reported debt as well. The plan is improved EBITDA, that inventory sell-through, and debt reduction in the second half, targeting positive free cash flow.
Okay, so a clear focus on cleaning up the balance sheet the back half. That's a strong signal, but
the market needs to see it happen, right? Promises versus execution.
Exactly. Now, looking forward, they mentioned a couple of potential growth areas. Less lethal personal protection.
Yeah, brands like Byrna and Taser, that category is apparently outperforming the company average. Seems like a growing niche.
And suppressors, direct-to-home fulfillment.
That one's interesting. They see potential for, quote, hockey stick growth there, especially if certain tax laws change in 2026.
Hockey stick growth, right. Which of those feels more immediate, though? Less lethal or suppressors?
Well, the less lethal seems more immediate. It's already showing momentum. It targets a specific customer base they've identified and probably has fewer regulatory hurdles right now. Suppressors have huge potential, especially with those potential tax changes, but it's definitely more dependent on legislation, more of a longer-term play with some uncertainty.
Got it. So let's bring this back to the investor perspective. We have this operational story revenue beat, positive comps, better margins.
Right. Sounds pretty decent on paper.
But the market reaction. Shares were actually up big, 14% before the call.
Yeah, anticipating good news, maybe.
But then after the release and during the call, the stock sold off in after hours, down 5.6%, then even further, maybe 7% off the close.
And on heavy volume, too.
Yeah, volume was way up, over 200% of average. That tells you something. The market digested the news, including that inventory and debt, and didn't love it initially.
So that sell-off, even with management painting a picture of improvement and strategic moves, it screams skepticism, doesn't it?
It suggests skepticism about the near-term execution, yeah. Especially around unwinding that working capital position. Investors seem to be weighing the good top-line news against the balance sheet concerns. Is the market missing the strategy, or is it rightly cautious about the execution risk? That's the debate.
That is absolutely the debate.
Okay, looking at guidance for the full year, fiscal 2025, they did tweak the sales outlook. Raised the low end, so now it's flat to up 3.5% growth.
Right, maintaining the top end but lifting the bottom slightly.
Adjusted EBITDA guidance was just reiterated, $33 million to $45 million.
No change there.
And capital expenditures, pretty modest, $20 to $25 million.
Yeah.
Mostly tech and store upkeep. Only one new store planned for November 25 in Arizona.
So not aggressive expansion, more focus on optimizing what they have, which fits the narrative of deleveraging.
Yeah. And digging into the analyst Q&A from the call, what were they pressing on?
Oh, they hit all the key points. How durable are these positive comps? What's going to drive margins in the second half, especially with, lower margins typically in hunting season and Q4 promotions?
Right, margin pressure.
They asked about demand trends into August management, actually noted an acceleration in NICS checks, which is positive. They asked about AOV, attachment strategies, that customer overlap between firearms and less lethal.
Trying to understand that new category.
Exactly. And future store growth management basically said, let's focus on sweating the assets we have and paying down debt before we get aggressive on new stores.
Makes sense. Anything else? Tariffs?
Yeah, tariffs came up. Management said they're watching it, engaging with vendors, and have some flexibility with MAP pricing to manage potential impacts, but it's definitely a risk factor out there.
So a lot for investors to weigh. Broader retail is okay, but discretionary spending is still shaky.
It adds complexity. But despite the market's initial reaction, you can see potential catalysts, right?
Like what?
Well, if they successfully sell through that inventory this fall without crushing margins, that's huge.
Yeah.
If they hit positive free cash flow, make real progress on debt paydown, keep gaining share in firearms and fishing.
Then the narrative could shift pretty quickly.
Exactly. If inventory gets back to normal like they guided and comps stay positive, you could see a story about strong margin and cash conversion emerge. That could lead to a re-rating.
Okay, so that brings us to our not financial advice segment. Time for a wild yet plausible trade idea.
All right, investment committee, let's brainstorm. Given this whole setup, the strategic inventory build, the clear plan for sell down and deleveraging, maybe there's an arbitrage opportunity here. Call it the sell-through and deleverage play.
Okay, I'm intrigued. What's the idea?
How about this? A short-dated, out-of-the-money call option spread on SPWH.
So betting on the stock price going up in the relatively near future, but with defined risk.
Precisely. Paired with, and this is the wilder part, a long position in a credit default swap, or CDS, on the company's debt.
Okay, unpack the CDS part. That's basically insurance against them defaulting on their debt.
Essentially, yes, it's a hedge. The thesis is this. The market, judging by that after-hour sell-off, is maybe over-discounting this Q2 inventory and debt situation.
Right, focusing too much on the temporary spike.
Possibly. Management laid out a very specific plan for the second half. Sell inventory, pay down debt, generate cash, if they actually execute that plan.
Then the market should, theoretically, recognize that and re-rate the stock higher. Right, as the balance sheet risk fades.
Exactly. The call spread is designed to capture that potential upside from the re-rating. The CDS acts as the hedge, the safety net. It protects you if things go wrong, if inventory doesn't sell, if debt paydown stalls, any major execution stumbles.
So it's a bet on management's execution hedged against failure, profiting if the market's current skepticism turns into appreciation later on.
You got it. It's bold, relies heavily on management delivering, but it directly plays that disconnect between the stated plan and the initial market reaction.
Definitely plausible, if a bit complex.
Yeah.
And definitely not financial advice.
Absolutely not financial advice, purely a hypothetical exercise.
Okay, so let's wrap this up. In summary, Sportsman's Warehouse posts another quarter of positive comps. Firearms and fishing look strong. Gross margins improved.
But Q2 also saw that strategic but significant peak in inventory and debt.
Right. Management's confident they can unwind that in the back half, reduce debt, hit positive free cash flow.
The execution over the next couple of quarters is absolutely critical. That's what investors will be watching like hawks.
Will the market reward the plan now or wait for the proof? That's the key question. This concludes our Talk Tickers deep dive on Sportsman's Warehouse.
Remember to do your own research.
Always, this is not financial advice. Until next time, happy investing.